And now we move on to um, the next contribution, which is titled "Regulating Core Growth," and we have nobody less than Eilís Ferran, Professor Ferran from Catherine's College, Cambridge, to talk to us. Eilís, just like Jennifer, has also authored a widely received book on corporate finance. And more than that, she has established a corporate finance LLM at Cambridge University. And so she's in every which way close to our research interests in here. And we're very happy to have you and excited to hear you talk. Thank you.
Thank you, Chris, and congratulations on such a fantastic conference. It's great to be part of it. So here's where I begin. I have a quote from Ashley Alder, who is the chairman of the UK's Financial Conduct Authority, the FCA. And I think this question helps to put things into perspective. So whether in London, Brussels, Hong Kong, New York, or Vienna, the same question is under discussion. How do we maximize the ability of sustainable, vibrant capital markets to drive greater volumes of investment into the real economy? And that's the overarching question. Just to be clear, when I talk about capital markets, I mean both private and public capital markets. And indeed, the interface between the two is a critically important factor. So, regulating for growth. This is something that is preoccupying policymakers and lawmakers in the UK, but also within the EU. Why? Well, it's not hard to see why this growth imperative has come to the foreground. The UK needs to invest to grow its economy, so too does the EU. And you can see from the figures there, the scale of the challenge. Both the UK and the EU recognize the critical role that the capital markets have to play as the enabler of these goals. Capital markets, when they function well, generally offer a superior mechanism for capital allocation efficiently to flow to the most productive investment opportunities. The UK and the EU both also recognize an important nexus between regulation and growth. That regulatory policy choices can make a material difference to growth prospects. That isn't universally accepted, particularly in the academic world, but let's just take it as shaping what the policy environment is in both the UK and the EU. It is popping up everywhere, this idea that regulation can make a difference. In the UK, for example, promoting international competitiveness and growth has been added to the mandates of the financial regulators. It's expected to be at the heart of a new UK financial services growth and competitiveness strategy, which is going to be published in July. On the EU side, you can see it permeating through a lot of the major position papers and policy positions in the EU. For example, the omnibus packages to simplify sustainability requirements in the EU investment programs, or the competitiveness compass, or this emerging strategy for the Savings and Investments Union. But when we talk about regulating for growth, what do we actually mean? Regulation is neither inherently pro-growth or anti-growth. It can be either, or indeed neither. It can have very limited usefulness. So echoing what Alperin said yesterday, there are root causes that regulation cannot fix. And if you're trying to change a capital market ecosystem, you can be sure that over-reliance on regulatory solutions is the wrong way to go about it. Regulating for growth, even though could go either way, is often perhaps understood as a euphemism for deregulation. Yeah. And that can take you rather quickly to worrying about lowering of standards and races to the bottom. My position is that race to the top, race to the bottom framing is too blunt. There is a shift to a more tolerant regulatory mindset on both sides of the channel. The governor of the Bank of France, in a recent speech, said, perhaps we need to sail a bit closer to the wind. There is a lot of talk about simplification and reduction of red tape. But we have to be realistic about the times that we live in. The chimera of open markets governed by harmonized global standards, that's disappeared before our eyes. There is an inevitability about the heightened awareness of the threats to national and regional economics in these disrupted times, and the need, therefore, for the capital markets to play a greater role in responding to those threats. So that's what my paper is about. The era of economic nationalism, this period in which both the UK and the EU are seeing a strategic need to use regulation differently. And my focus is especially on using regulation as a retention tool. What I mean is that for reasons of economic resilience, sovereignty, and security, the EU and the UK proactively seeking to use regulatory policy to create the best ground conditions for their domestic companies and their domestic investors to grow, to invest, and to stay in their respective markets. So I'm focusing on improving the pipeline of domestic companies and improving the flow of domestic capital, retail and professional, into domestic assets. I'm not the only one who sees this rise of retention as a key policy imperative. Larry Fink, BlackRock CEO, in an opinion piece published in the FT very recently, said that what he's seeing across the world is that countries are moving to steer more of their capital home. I think he's right in that. So I'm not saying that London somehow is no longer interested in being the place where the world comes to do business. I'm not saying that the competitiveness of the EU capital markets as a global issue is no longer important. Of course it is. International portfolio diversification remains an important investment strategy. All I'm saying is that the world has changed and protecting domestic markets has moved to top of mind. So fitting this into our themes of regulatory competition, using regulation to pursue an economic nationalism agenda is in effect engaging in defensive regulatory competition. I'm not here talking about the UK and the EU competing with each other in a post-Brexit world. I'm talking much more about the UK and the EU engaging in their own separate competitions with the US. There is an extra layer of complication for the EU because, as we saw in a number of papers yesterday, we also have that competition within the EU between member states, the Netherlands, Italy example that was referred to a number of times yesterday. Now, regulatory competition can only work when companies and capital can move freely between different regulatory regimes, when they can engage in arbitrage. The UK and the EU are seeking to counteract this by making their home regimes more attractive. At least at this point, we're not seeing more heavy-handed forms of protectionism, although there are some traces of that beginning to emerge. Yesterday, a number of speakers referred to the classic works on regulatory experimentation and competition and the way in which that can be an animating force for well-designed capital market regulation. Many of those papers, the last time we had a peak of interest in this topic was around the beginning of 2000, before the financial crisis, in an era when perhaps we all still believed in globalization, and we certainly all believed in a rules-based international order. So we didn't have that recognition that we have now about the threats of globalization. So we have to put those papers in context, but I think they can still be helpful, and they have a lot to teach us, but there are some limitations. So regulatory competition can be a disciplining force. It can drive quick correction of policy mistakes. It can provide incentives for regulatory innovation and learning. But regulation won't ever be the right solution to all the problems we have, as I said before. And critics of regulatory competition are right to point out that thinking about law as a commodity and then thinking that you've discharged your policy duty if you simply craft your rules to meet the preferences of major market actors is liable to underserve the public interest. So there are qualifications to what we can learn. With that in mind, let me turn to a little bit more detail. Far too much detail on this slide, but what it is attempting to do is just to capture similarities and differences between the EU and the UK's policy agenda. So both are trying to make changes in their capital markets. The EU focusing on Savings and Investments Union, reducing the high dependency on bank lending. A lot of policy initiatives flow from that. The UK, an international financial market, second only to the US in many of the surveys, worrying about decline and wanting to revive its listing market and more generally as well. So similarities and differences there, both of them focusing on growth companies as the engine room of their economies and of the growth that they are looking for. I want to look at growth companies in a little bit more detail in a moment. But before that, just to say a few words about other things in this slide. Both the UK and the EU have identified domestic retail investors as a significant underutilized source of growth capital. Differences in the detail, the EU has the problem of lots of retail household savings, but too much of it sitting in bank accounts that pay little or no interest. Unlocking that is the agenda for the EU. The UK has the lowest household saving rates in the OECD. So it needs to get its retail investors to save more and to put more of it into their capital markets. On the other hand, the UK has one of the highest investments in pensions in the G7, helped a lot by the UK introducing auto-enrollment, where employers have to put their employees into some form of pension. Most of the EU doesn't have that. And on pension funds, major point of attention on both sides of the channel. For the EU, reducing fragmentation in the pension sector, but also getting more funding going into pensions. The UK has a different issue, quite a lot of funding in pensions, but not enough of that in the government's view being invested in domestic assets. So the UK agenda is also to reduce fragmentation in the sector, but also to get the pension industry to develop more of a home bias. This is one point where we do see shades of really heavy-handed economic nationalism coming in. So far, the UK government has lent on the pension industry voluntarily to invest more in UK assets, but in a new pensions bill that they will be introducing into Parliament soon, they are holding out that they will include the possibility of a power to mandate investment in UK assets. So that would really be a very different world we'd be living in. What I want to do now is take this a little bit more of a deep dive into growth companies and the policy agenda in the UK and the EU in relation to those. And I focus on this area for some key reasons. First of all, the persistent difficulty of closing funding gaps for growth companies and of providing exits for investors in privately owned companies, where you have the problem of no or very limited secondary market liquidity. Those are long-standing problems. Added to that, we now have the growing importance of private capital markets, Starring spoke about yesterday. All of those different factors have elevated this policy area to one of strategic importance. And so there is a key driver of the regulatory agenda on both sides of the channel in terms of closing that funding gap, in terms of providing exits for investors in privately owned companies, and in responding to the phenomenal rise of private markets. private equity, private credit, venture capital, and the like, alternative funding mechanisms. What I find in the research in this paper is that both the UK and the EU are following the trend towards having more lenient standards in public markets aimed at growth companies. But the UK is doing something else as well, positioning itself as a regulatory innovator by putting forward what it describes as a new type of stock exchange, a stock exchange for privately owned companies on which they can intermittently provide secondary market liquidity. Let me talk about this innovation briefly. So this is PISES, the Private Intermittent Securities and Capital Exchange System, which is a flagship response by the UK to the new realities of private markets and the preference of more and more companies to stay private longer. The one thing that you have a disadvantage of if you stay private for longer is secondary market liquidity. You can raise your capital perfectly well from the vast sums of money flowing into private markets, but at some point, those investors will need an exit. So the idea of PISES is essentially to provide a public market infrastructure to support private markets. The general idea is to provide a regulatory framework that provides greater transparency and efficiency than private markets on their own, while not applying public market disclosure standards. And the twist is not to do the usual thing for growth markets of saying, here are the standards we apply to the main markets. Now let's take some of those away. Let's make them lighter. So public minus as the established strategy. Instead to say, let's start with the norms of the private markets and add a bit of transparency and disclosure and dedicated enforcement in relation to those. So private plus as an alternative. And the fact that this is being done by means of a bespoke regulatory framework is where the UK is making this claim to be an innovator. There are private markets, NASDAQ, example, private markets has led the way, Deutsche Börse, Ford, you can find other examples, but it's the fact the UK is providing this regulatory framework that is the distinctive point. There are three potential niches that PISES could fill, I suggest. First of all, it could be an on-ramp. So getting growth companies in the mood to go public, getting them used to a bit of public market disclosure, but on an intermittent basis. It could function as a way for venture capital and private equity firms to sell out, to realize some of their investments. So an alternative mechanism for exit. And of course, it could function as a way for growth companies to be able fully to exploit the flexibilities that come from being able to pay their employees in shares and share option-based remuneration packages. Don't have time to go into all of the detail of PISES, this bespoke framework, but just to pick out a few of its features. So it's secondary market only, it's not capital raising, it's intermittent trading, and the timing of trading is entirely under the control of the companies in question. Companies that can use PISES could be UK companies or overseas. The only criterion is that they are privately owned, so not listed or quoted anywhere already. Investor eligibility, professional investors, high net worth, sophisticated investors, and employees, not general retail investors. And then companies can also restrict eligibility further, so they can actually set conditions on who can buy their shares. In terms of pricing, companies can set pricing parameters. So not like a public market where you rely on the mechanisms of public markets to essentially discover the price. Some mandatory disclosure requirements, but much less than you would see on a public market. No general duty of disclosure in terms of all material information, and perhaps most notably at all, no continuous disclosure obligation and no market abuse regulation type restrictions on insider dealing. So a rather different type of stock exchange in many ways. So it's a bit of an odd creature then, Pisces. It's a stock exchange, according to the FCA, but most of the traditional safeguards that we would expect in a stock exchange are not present. That's experimental. Could be that actually nobody trusts Pisces at all. It just never gets off the ground because it doesn't have the minimum level of trust needed for companies and investors to see it as a long-term sustainable option. There are a lot of questions about whether venture capital funds and private equity firms, who are really the key investors that policymakers want to attract into this framework, will actually see the value of it. Critical point being portfolio valuations. In theory, all this information, issuer disclosure and pre and post trade transparency documentation, stays within the private perimeter. So only the eligible investors get access to it. But in reality, it is likely to be more porous than that. And so there is a risk that these mechanisms could set a price that is potentially quite low and certainly quite volatile. Mm. And that is likely to be a disincentive to private equity firms, venture capital firms in using this mechanism. I talked about this point at a conference at the LSE, London School of Economics, not London Stock Exchange, quite recently, and Sarah Patterson, professor there, made a really pertinent point. Her suggestion was that perhaps for the private equity firms, Pisces is coming along a little bit too early, and that its appeal to that category investor will perhaps depend on whether their current difficulties in finding exits intensify. Mm. But if Pisces becomes a dumping ground for assets that private equity firms are otherwise struggling to sell, and they are bought up by investors that previously were shut out of opportunities to invest in these alternative asset classes, then the negative repercussions of that are going to be significant. So that's the top of that slide. There's another scenario, though, as well, which is problematic in a different way. Let's say Pisces works and it's this great success and lots of investors start using Pisces, and this is the magic, wonderful way in which private markets can become even more of a way in which companies stay private, and the whole world changes to this different world of stay private, intermittently go on a public market. What does that do for growth markets in the public capital markets sphere? So AIM, which is the London Stock Exchange's growth market, is it going to be helped by Pisces, that somehow they complement each other, or is it going to be killed off by Pisces? I think you can debate it. The London Stock Exchange is currently doing a review of AIM, describing it as the jewel in the crown and, this great thing, and pointing out that actually it's the most successful on some metrics growth market in Europe. But it kind of feels like a bit of an afterthought. Pisces is about to go live. The London Stock Exchange has been one of the biggest kind of promoters of this new stock exchange. And now it's kind of getting around to saying, oh, but we still like AIM too. Not sure that that's really convincing. If AIM doesn't work, then, maybe that's just Darwinian. We've demonstrated that these things aren't needed anymore. But if you want to get your retail investors into investment opportunities, they're excluded from Pisces. We tend to think retail investors, growth markets, good entry point. There's an incoherence there about the retail investor strategy. So what about the EU then? Well, in terms of Pisces, not yet, I think, is definitely where things are. But that there is a watching brief is evident. So the European Commission in the savings and investment plans said that by Q3 2026, it will put forward measures to support exits by investors in private companies, possibly through multilateral intermittent trading of private company shares. So I think we'll wait and see what the early days of Pisces look like. And of course, the European Commission, the European lawmakers could adopt a variant form that puts more investor protection into place. So they couldn't necessarily simply have to take the UK version in its entirety. At this point, though, I think the EU has perhaps more pressing issues and different issues to focus on, to explain why Pisces is not rushing to the front of its policy priorities. First of all, the things I've said about the risks involved in it, but there are other considerations as well. First of all, London Stock Exchange really promoting it. I don't see that coming from either Euronext or Deutsche Börse. And indeed, what you see from Deutsche Börse is a very different message. The chairman of Deutsche Börse has been extremely vocal about the fragmentation in the EU trading landscape. Hyper fragmentation, they describe it. And I will come back to the details of that in a moment. Well, if you're worried about your existing trading landscape being overpopulated with trading venues, adding another one isn't the obvious solution to your problem. There is also the difference in the retail investor sort of position. So the EU has a nice problem in a way. It has around 11.6 trillion sitting in bank accounts, household savings, private wealth. Not being fully leveraged to meet the EU's strategic needs. So this is what the European Commission says, if we could even get a little small proportion of that amount flowing into the financing of EU companies, that creates this virtuous circle, good returns for citizens, support for local economic activity, benefiting all of us. If that's what you're really worried about, even with a variant form Pisces, you're not really going to embracing that solution. So the EU stays more with the traditional public minus approach. So yes, very much, let's facilitate scale up. This is not just an economic imperative, it's a strategic one. Let's really look at how we can make things like the growth issuance prospectus work better. Is that really going to make a difference? It underachieved in its previous form. We've now got a new version of it. Will it make a material difference to capital market activity? Let's see. Other listing act deregulatory steps, the reduction in free float requirements, that seems to now be sort of the norm everywhere. The introduction of multiple voting shares structures, but only for multilateral trading kind of venues, so MTFs, not yet on listed markets. So the other way around to the UK, which went for dual class shares on the listed market, and only now is there talk of it also being applied to AIM as well. So unsurprisingly, the EU's approach is being debated. Klaus Haupt has said it falls short in only being limited to growth markets. And Schmidt has said it's only a basic harmonization, but a start and things can grow. So she's a bit sort of kind of balanced about it. But she does also say, well, the lawmaker could have shown more courage. I think the absence of courage could potentially link into some of what we talked about yesterday in terms of the competition between member states, and that actually the political environment of the EU as to kind of, the Netherlands wanting to make itself the Delaware of Europe and actually being quite successful in attracting companies to list on Euronext. Amsterdam could be a factor in play there as well. So there are other considerations in play as well. There are other proposals, the kind of increasing the eligibility limit for growth market from 200 million to 500 million would allow growth markets to capture a larger pool of companies potentially. And then, of course, there is the wonderful 28th corporate law regime. We've all seen these additional, there was the 29th in a previous period when the UK was still around. I think it's hard not to be skeptical about that moving at the pace needed to respond to this great economic need for growth. And that's where I want to come back to this idea of you can't look to regulation to solve all your problems, and linking that to the discussion about the fragmentation in the trading landscape in Europe. So again, I'm quoting here from a Deutsche Börse paper. 500 trading and execution venues across all asset classes. So perhaps no wonder that sort of Stephen Leithner labels that as hyper-fragmentation and claims that it is the most fragmented across all developed countries. Fragmentation is a problem. It drains liquidities, it gives information asymmetries, and so on. It limits market size, hampering firms' ability to scale up. And it has been cited as a key reason why EU companies find IPOs in the EU less attractive than in the US, a key motivator of moving abroad. So how do you address that hyper-fragmentation? Things have crystallized a bit. There was a period when it looked like some top-down solution might get some policy backing, but I think that this most recent statements in Savings Investment Union would suggest that the need for this to be market-led has been more fully recognized. This is an area where the commercial market can do better than the law market, would be my simple message. Here's where I want to end. So wrapping this all background to ideas of regulatory competition, what we can learn from regulatory competition, what we can't learn, and what we should be cautious about learning. So I've been talking about the UK and the EU facing the competition from the US in particular, worrying about outward flows, and then that sub-level of competition within the EU between member states as well. Labeling this as economic nationalism, form of defensive regulatory competition. My findings are in three areas. First of all, about diversity in legal transplants. Secondly, about the limits of regulatory solutions. And thirdly, about the misalignment between market preferences and the public interest. Diversity. So in theory, regulatory competition can drive convergence towards the most successful regime. That's the idea on theory. It's a fallacy. Transplanted rules will never operate in their host countries in exactly the same way as in their home country. But that might be no bad thing from a retention perspective. So the UK and the EU are to some extent responding to retention risk by conforming their regulatory regimes to be more like those in the US. It's a bit of a retreat from the idea of, global intellectual leadership, Brussels effect, and all of that. But as a pragmatic response to retention risk, maybe okay. Offering US-style regulation, but with a local flavor because of your domestic institutional context, maybe could increase the appeal of domestic markets for your homegrown actors. So if that's your regulatory objective, then maybe there's a logic to this. Sometimes following can be better than leading, depending on what you're trying to achieve. Secondly, on the limits of regulation in addressing ecosystem issues. So the EU's efforts to stimulate more SME use of growth markets. And the UK's attempt to say, we're going to have Pisces and we're going to have AIM working alongside each other. Those are attempts to use regulatory solutions to address ecosystem problems. But again and again, regulatory solutions have not catalyzed vibrant growth markets. Maybe we're missing the point. We've talked about private markets. We've talked about companies staying private for longer. We've talked about shrinkage in the listed market. Well, if there's shrinkage in the listed market, it stands to reason, it's only sort of logical common sense to say, then the demand for growth markets will be even less again. I'm not going as far as to say that growth markets and trying to make them work is flogging a dead horse. I think there are still good policy reasons to try to make growth markets in the public sense work and to have them as part of a rich menu of funding options. But if you want to make them work, you have to recognize they're up against very strong market forces. And so you have to use every tool in the policy toolkit to try and make that happen. Hollowing out regulatory standards to give growth markets a better chance of withstanding to competitive pressures would not end well. There's only one end in that, and it's a bad one. So you have to look at other options. So looking at ways in which the market can address the hyper-fragmentation. There are 31 growth markets for SMEs, according to ESMA data. 31 SME growth markets or MTFs that target SMEs. And even when you factor in that some of them are part of larger stock exchange groups, that's still an awful lot for growth markets. So finding ways to rationalize the growth market and to reduce fragmentation there would be perhaps a good way forward. And then my final point, the interrelationship between regulatory competition and the public interest, and the worry that some have about treating law as a commodity. I think there is real substance to that concern. And let's think about it in relation to Pisces. So let's say Pisces is this great success and it allows companies to stay private for longer, and we have this new world where that's the norm, and actually the listed company group becomes an increasingly small global elite of companies. All good and fine, but Pisces is a regulatory intervention. If it accelerates the trend to stay private, then in effect that is giving a public blessing to this new state of the world. And I think if you give a public blessing in this way, you also, as a policy sort of environment, need to think about what you've created. You've created a system in which your assumptions that have underpinned your corporate law, your governance, your capital market regulation, that large companies will be publicly traded, no longer holds. And so you have to start thinking really differently about all those elements of your corporate and capital markets regulatory framework. Thank you.
Thank you, Eilís. Plenty of questions, I suppose. I start this time with Martin, then Alper, and then Dominic.
Yeah, so thank you for this. I have a number of comments. One is maybe a more scholarly one. One is going to be a policy rant. The more scholarly one is the introduction of Pisces reminds me a little bit of the Hansman and Pargenda theory of regulatory dualism. I don't know if you thought about this, because usually the idea is that you introduce a different market segment to for sort of innovative companies that want investor protection in order to get around incumbents who have policy grip on a country with bad regulatory instruments. And I wonder how that's I mean, here it seems to go in the other direction. in the direction of deregulation, and I wonder how this flips that theory on its head, and that's kind of interesting, I think, from a scholarly perspective. Now the policy rant. I'm glad that you talked a lot about pensions and retirement systems, and I wish some Austrian policymakers would be here, because just from my experience in the US and here, and I think it's a similar disaster in other continental European countries, but what I think countries like Austria, maybe the EU, should look at are 401k plans, private self-directed pension plans, IRAs that exist in the US and work pretty well for high and middle income earners. And every time something like this is introduced here, they have requirements such as everything has to be invested in the European Economic Area. Everything, there has to be a very high percentage of secure bonds, which I think is malpractice to require for 30-year-old, 40-year-old workers who probably should be purely in equity, and who should be allowed to decide themselves where to invest their stuff. Not only in the EU, they should be able to invest worldwide to get diversification, which would allow them to which would also allow countries with a declining population to secure retirement for people by diversifying their long-term risk. I think one really important key thing that the EU could do in this area is to ensure to nudge countries to introduce these kind of systems, and also ensure the mutual tax recognition of the tax treatment, because often they are tax advantage in the sense that in the US either you pay in pre-taxes, or the other type of plan you pay in post-tax money, and then it's never taxed again, even if it grows. And I think that's something that doesn't work well between countries worldwide yet. Between the US and European countries and the EU, I think could do something there. And I think there could be a beneficial impact on European capital markets if this kind of thing were implemented effectively, and even if we don't require people to invest their money within the European Union, which I think is a really bad idea.
Yeah, I'll start on the pensions point, and I mean, basically to say I completely agree with you, and I think this is one of the areas where but the one thing I would add would be around looking at the prudential regulation of insurance and pension companies, that this over investment in very safe bonds and assets, and not sufficiently in alternative asset classes and the like. There is movement, but it can probably go a bit further. And in that respect, the kind of perhaps the sailing a little bit closer to the wind idea in respect to prudential requirements. It's actually quite good that even governors of central banks are articulating that. And I think in terms of the regulatory dualism, that's a really good point that I need to sort of do a little bit kind of more on. I think that I think the Pisces experiment is worth trying, kind of thing. But who exactly it's going to help is the big, trying to kind of say we're going to replicate what the private equity firms do privately, but put this layer of kind of some transparency around it. If it fails, it's embarrassing, but there you go. If it succeeds, that could be potentially worse because of the risk that it stores up for the longer term. I think the most vocal proponent of it in the UK has been the London Stock Exchange, really, above all others. And I think that kind of it speaks to their recognition that, they spent a lot of time changing their listing rules, but actually that's only ever going to have a very limited impact on their position. Yeah. Yeah.
Okay, so who's next? Alfred. And then Dominic.
I found this such a rich and fascinating discussion,
Yes,
which provoked many thoughts, but I will keep it to two thoughts. One is, so you mentioned UK being more NASDAQ, but with a local flavor. So I wonder whether UK will come to regret that, because yes, UK got rid of the formal shareholder rights that existed on so many corporate transactions, but yes, had this strong fiduciary duty litigation and securities litigation, which Holger Sparman calls indirect investor protection, but the UK doesn't have this. So UK has very low derivative action. Also, securities enforcement is very weak. So I wonder whether UK will actually come to regret getting rid of shareholder rights, which were actually functionally equivalent to the ex post indirect investor protection the US had. That's one comment I had. And the other question is relating to this new private market. I think you alluded to this, but a cynical law and economics scholar would just say, what is the market failure? UK's claim is the bespoke regulation, but I mean, what's the market failure that the regulation is trying to solve? If there was like a market demand for this, market would just create this, and they did it with NASDAQ, etc. So what is the UK regulator trying to achieve? And the usual suspect the regulation would address is like insider trading, and there's no ban on insider trading. So what is the regulation trying to achieve that the market couldn't achieve itself? So it's an interesting aspect, I think.
Good point, yeah.
So NASDAQ without US enforcement, I mean, this is my kind of, well, maybe that's not too bad, really. You know, you get lower standards, but you don't get US enforcement. That might be something that makes it a bit more palatable for UK investors. You touched on other reasons why UK companies might actually not really benefit from going abroad. So this could be another factor. It could, of course, mean that we, you know, if we still want to be open to the rest of the world, we could attract kind of other companies coming into the UK for bad reasons, the kind of bond, you know, the bonding thesis to a lower kind of quality regime as well. So that would be my response on that. In terms of
Market failure
point, I mean, I agree. That's what I'm saying. It's this experiment could just simply not work at all. I mean, I think there is a problem of secondary market liquidity, and that is a real problem. If you're a privately owned company, it's actually, yes, you can, and even if you're a very big one, like the one I know very well, I mean, yes, you can find secondary market investors. You pay a very large amount of money to investment banks to help you do that. So there may be something here, which is more cost efficient than sort of what the market is already providing. But
so basically just a facilitator for the provision of liquidity and not necessarily market integrity and other safeguards. Okay, yeah. Dominic, and then Nareen.
Thank you.
And this is where I have to close the list because, yeah.
I'm gonna try to keep it as short as possible. Thank you so much, ma'am. So the face of gatekeepers is changing. I haven't spoken to Steve McWirth, the former FCA, now Binance Global Policy Lead. You know, fractional, or let's say defragmentation by virtue of tokenization and fractional equities are a reality. So to your mind, is it With regard to the UKBA and the thresholds the UKBA foresees for publicly listed companies in terms of 10%, even in the case of a dual listing for publicly traded companies, does ICES foresee a similar kind of narrative? Because I would assume that risk retention with regard to companies and entities staying private for longer in order to dodge transparency frameworks might wreak havoc in the long term.
I'm not sure I've got the
10%, like UKBA is 10% for publicly listed companies. Are you aware of any similar provisions with regard to PICEs in private markets going into the future?
No, I'm not aware of any. And I think that that perhaps the point goes to my last point about if this is the new normal, then we need to focus on a whole different set of questions about how you continue to have an appropriately differentiated sort of corporate and regulatory framework, so that you have the right level of kind of regulatory burden for companies at different stages of their development. But you're never going to have perfect. There's all levels of tiering. There's always going to be room for arbitrage around the margins. But when you can see that your existing tiers and the kind of benchmarks you use for those tiers are becoming increasingly misaligned with market reality, then you've got to start thinking differently.
Very good. Last question to Marie.
Very quick. I really like the paper. It's so intellectually stimulating. You mentioned the questions about trust issues, and perhaps it's too early, maybe exit difficulties will be there in the private markets. Private equity, private credit, venture capital, UK is the second biggest market here. But a lot of the story also comes from the US, because the US funds, Apollo and the like, are driving this story. And there's a lot of discussion by Apollo and the others in creating retail market for equity and debt in this area. So my question is, will we need a blessing from this US funds in PICEs? And if we don't get that blessing, I'm wondering whether this may drive even more ingenious innovation on the private side of the story of creation, new sort of structures which will be competing with PICEs, and what would be the implications of this for London as the second, global market where the funds are investing. Does that make sense? So I'm wondering whether would this be just about, if it doesn't work, is it just embarrassment, or are we intensifying this clash between public ordering solutions that may or may not work? And I mean, I'm very much in favor of this, just to be clear. Or, yeah, that's my question. It's a UK story, but the biggest investor is US firms. And do we need that blessing here? And the lobbying comes from London Stock Exchange, the way I understand it.
Okay, so just unpacking a number of bits of your question. So I think in terms of retail investors, which is where you started, I think, although it's incoherent in a world where you want to encourage retail investors to develop an investment sort of habit, to do things, say your flagship thing is something that they're not part of, I think on balance it's the right solution given the risks. And I would link that to Martin's point about pensions. I mean, kind of, yes, we should be encouraging pension funds to be able to invest in a full range of risk-based assets, and encouraging people to invest more in pension savings. So that's an indirect route in terms of whether you need the kind of blessing of the US funds. I mean, the bottom line is, if the dominant market actors aren't interested in what you're serving up from a regulatory perspective, then the market will tell you, all you need to know about your ability to align kind of, regulatory choice with market preferences.
Yeah. On that note, thank you so much.
Thank you.